Welcome back. Office Space Solutions is in focus today. This, remember, was one of the recent listings, I think listed about 2 or 3 months back. And just last week, the stock zoomed to its all-time high levels of 946, a 140% premium to its issue price of 383. But in the last 2 days, the stock has come under pressure. So from levels of 940, it's now down to 775. Now, there are two sets of news flow that we wanted to discuss. So last week, the company announced in a press release that they're expanding their footprint in Bengaluru and they've unveiled more than 66,000 square feet of premium workspace. Also, their Q1 numbers were out recently and it was a strong showing, 37% revenue growth, 56% jump in the EBITDA. To talk about the way forward, we have Amit Ramani, the CMD of the company, joining in. Amit, thank you very much for joining in. First, if you could talk about your expansion plans. Now, you've already indicated that you added 15,000 new seats in Q4, 5,000 in the quarter gone by. So for FY25, what will be the seat count addition? For FY26, I think you've spoken about 40,000. And now with this Bangalore facility coming on board, which you recently announced, how many seats are we talking about? Just break it up in terms of timeline.
Sure. So we had announced, at our last earnings call that we ended the FY24 at roughly about 95,000 seats. We added another 5,000 seats in the last quarter, so we have about 100,000 seats operational. In addition, we have close to about 12,000 seats that are currently under fit-out, and another 15,000 on top that essentially are going to be in the LOI stage right now, and which will convert into a fit-out in the next few months. So the target for FY25 is essentially 135,000 seats. We'll add about 40,000 seats this year. Obviously, the Bangalore facilities are part and parcel of that overall number that we are targeting for FY25.
Okay, so this 1.35 lakh seats that you're targeting by the end of FY25 includes this Bangalore facility?
That's correct.
Okay, and have you spoken to any clients? What is the kind of occupancy that you anticipate by the end of FY25 for this, 1.35 lakh seats for mature and even on a consolidated basis?
Sure. So, Reema, if you look at the whole outline, the last quarter we reported an overall occupancy of 71% and a blended occupancy for centers which are more than 12 months operational of 84%. At least the guidance for the future FY25 is that we will exit FY25 also along similar numbers because the seat addition continues to be at a rapid pace. For FY24, for the 12-month trailing, we had added close to about 30,000 seats across 48 centers. So the seat addition is happening rapidly. Hence, our guidance for FY25 occupancy is 70+%, and for mature centers of 12 months or more is 85%.
Mr. Ramani, the street, of course, has been liking your pace of growth because it's outstripping, I think, the general growth levels as well. I think there are estimates ranging between 25% to 26-27% in terms of flex working spaces overall. But you've managed to grow at 30% plus. Now, there are estimates on the street that project you growing at 40% and more over the next 2 years, 2 to 3 years, on a CAGR basis. Is that a fair assumption to have? Do you think you can, sustain at 40% growth rates?
So we've given the guidance of 30%. We ended FY24 at about 850 crores top line, and we have given a guidance of about 1,100 odd crores. We will continue to keep that guidance. Obviously, one area where we are very focused on is our operating efficiency and operating leverage. We have given a guidance of 1.5% on our EBITDA. And for this first quarter of FY25, we were already overachieving that. So I think clearly focus is on growth, but I think the guidance continues to remain at about 30%. But there is a very focus on improving the EBITDA margins and ultimately the PAT and the profitability.
Speaking about margins, I just wanted to understand the difference and the margin sort of variance between the two models, the managed aggregation model versus straight lease, and you do a mix of both. So just explain what makes better business sense and what's the targeted mix that you look at, by the end of the year.
So see, if you look at globally, some of the straight lease models have not been that successful, right? We've seen that what challenges they come with, because you are taking the primary risk. When you are taking a straight lease, you are putting 100% of the capital, as well as all the occupancy buildup is on your plate. So from our standpoint, when we coined the term managed aggregation, our model was partnering with the landlords. And as a result, what we end up doing is that we partner with the landlords for two things. One, we ask our landlord partner to put in the capital towards the fit out, a large portion, typically anywhere between 80 to 90%. And then we request them for a operational minimum guarantee free period. And even after the minimum guarantee kicks in, usually it is about 50% of the market rental. So it has done two things. The managed aggregation does two things for us. One, it mitigates our risk because our landlord becomes our partner. Second, we become asset light because our landlord partners are putting in the capital. Obviously, in that model, the margin, contribution margin at the center level ends up being lower because I'm not putting in the capital and my landlord partner is taking the risk. So in a typical profit share model, after covering the operating expense, 70% of it typically goes to our landlord partner and 30% comes to us, which translates to about 23 to 24% for us at the EBITDA level, at the center EBITDA level. In a
Got it.
model, yeah.
So sorry, I'm so sorry to cut you short. Actually, we're a little short on time. We got that. That really helps us understand the way the model's working. Now, and straight lease is different. I mean, it all comes to you, but you're taking on, the bulk of the risk as well. Now, going forward, what's going to be your strategy? You're saying globally it is a managed model, which is sort of perhaps working better. What's the targeted mix that you will hope to achieve, and what's that margin rate, blended margin rate, that you will want to sustain at, again, on a steady state 2 3 year basis?
So currently we are a 65% managed aggregation, 35% straight lease. The guidance continues to remain in that direction. We will continue to do straight leases where we already have demand with us, and we will do speculatively our managed aggregation. So the ratio will remain. As far as, our numbers in terms of margins go, we currently do about 23, 24% in managed aggregation and about 30+% in straight lease. So at a blended level, we will be in the 25 to 26% at the center contribution level, center EBITDA level, which obviously translates into, the overall company EBITDA as well.
Amit, out of time, but thank you very much for joining in and wish you all the very best. Need to get into a break on that note. On the other side is our special segment, Fin Street. Stay tuned.